There are two fundamental concepts in accounting. We have what we call the accrual basis, and then we have what we call the going concern assumption. We'll call it the going concern concept. In today's session, those are the two that I'm going to explain. Of course, there are several other accounting concepts and conventions that are being used or that are used by the International Accounting Standards Board to prepare financial standards. Accounting concepts and conventions that are used by financial accountants across the world when they're trying to come up with financial statements. And I am going to cover them, each of them in its own separate video, and I'll be explaining them in detail. But in today's session, I am going to look at the two key fundamental principles, call them concepts, that underpin financial statements or the accounting. And that's the accrual basis and then the going concern concept. So when it comes to the going concern concept, it simply states that financial statements are always going to be prepared under the assumption that the business that you are dealing with is going to be operational in the next foreseeable future. And when we are talking about the next foreseeable future, we are talking about the next 12 months. So financial statements, whenever they're being prepared, they are being prepared under that assumption that the business is going to survive or the business is still operating in the next foreseeable future, or the assumption is that the business's operations are not going to scale down in a material way, or they're not going to scale down in a major way in the next foreseeable future. So that's a very key underlying assumption when we are preparing financial statements. So now, does it mean that whenever businesses are operating or whenever we are preparing financial statements, does it mean that these businesses are always going to be a going concern? Or in other words, does it mean that this business will be operational in the next foreseeable future? It's not always going to be the case. So then what happens in case the business is closing? Let's say we're preparing financial statements and the fact of the matter is that the business is closing. It's not a going concern. So under such circumstances, you are supposed to disclose that fact. Number one, you're supposed to disclose the basis for which you're preparing upon which you're preparing those financial statements, and you are supposed to also disclose why the business is no longer a going concern. To throw more light on the concept of going concern, it normally weighs in at the point when we are trying to measure assets, inventory. Let me give an illustration. Let's say I have a shop and I sell shirts. Okay, so if I have a shop and I'm selling shirts, let's give a case in point. I purchased 10 shirts from my supplier. Okay, and I purchased each of these shirts at, let's say, 10,000 each, and I am supposed to be selling these shirts at 20,000 to the general market. So in the process of doing business, I have 10 shirts. So at the end of the year, I'm only able to sell 8 shirts. So if I'm able to sell 8 shirts, it means I have 2 shirts that remain unsold. So the question is that how do I measure the cost of these 2 shirts? There are 2 scenarios here that I would like to explain. So how do I measure the cost of these 2 shirts when the business is a going concern? And how do I measure the cost of these 2 shirts when the business is not a going concern, or in other words, when the business is going to close down? It is going to scale down its operations in a material way. So let's look at the first scenario. I have been selling my shirts. I bought 10 shirts. I sold off 8 at 20,000 each. What is remaining in my store are 2 shirts that have not yet sold. Remember, I bought these shirts from my supplier at 10,000 each. So if my business is a going concern, or in other words, if this business is going to remain operational in the next foreseeable future, then it means that I'm going to cost these shirts are going to be valued at their purchasing price. That is at their cost. Okay, So it means that in my books, these shirts are going to be valued at 10,000, and definitely they are going to be carried forward to the next financial year, and they will be waiting to be sold off so that we are able to realize a profit from them. So that is how we treat those shirts if the business is a going concern. So in other words, if the business is a going concern, the cost of the shirts will be their cost price, or in other words, the price at which I purchased them, which is the 10,000 I've told you. Now let's look at a scenario where I am operating the business. Yes, it is still the same 10 shirts that I bought, so during 10,000 each. So during the year, I sell off 8 shirts, I remain with 2 shirts, and now it is time to prepare financial statements at the end of the business, and the business is closing. It's not going to be operational the next financial year. So what is going to be the cost of the shirts? So now, when it comes to that scenario, the cost of the shirt is going to be the cost of how much I would realize in case I sold those shirts at that point. The terminology here is what we call a forced sale, because here the assumption is that you're closing down business, maybe things are bad, and so it means that if you're liquidating, that is. So if you're liquidating, it means that you are selling your shirts at a price that is not favorable. It's below market value. It's a forced sale. So the amount of money that I am capable of getting from that forced sale is going to be the value of the shirt. So in this case, I bought these shirts at 10,000. Normally, if the business was a going concern, I would be selling them at 20,000 the following year. But since the business is closing, it means I'm going to sell them at a forced value. Let's assume the forced value is 8,000, okay, per shirt. So I sell the shirts at 8,000 each. That's the first value sale. So the 2 shirts, 8,000 times 2, that is 16,000. So that would be the value, the value that we are going to allocate to that shirt. So what I've just described is just an example on how financial statements are handled when the business is a going concern versus when a business is not a going concern. So that is the going concern concept for you. Now let's talk about the accrual basis or the accrual basis. Again, the conceptual framework of accounting states that, the accrual basis of accounting is going to be applied when we are preparing financial statements. Now, what do I mean by accrual basis? Here is the thing. Let's get back to my illustration of the shirts that I am selling. Like I said, I buy these 10 shirts, each at 10,000 shillings. Okay, they are in my shop, and now I am selling them. Of course, let's say I sell off, like I mentioned, I sold off 8 shirts at the end of the year. So I sold these 8 shirts to someone, and this person that I sold these 8 shirts to did not pay me cash. The shirts are out of my shop, yes, but the person just has not yet paid me, but they are not in my shop. So in other words, I do not have anything to account for them. They are not physically in the shop, but they are out of my shop. So now the question is, do I recognize that revenue? Yes, we had a contract. I sold off the shirts. So what do I do? Do I recognize that revenue? That, well, I sold off the 8 shirts, where even though I've not yet received the cash, but I've sold off the 8 shirts. Do I do that? Or do I have to first wait to receive the cash, then I recognize the revenue? That's the dilemma. It's the end of the year. You gave out the shirts, you sold them, but you've just not yet been paid. So there's the question whether the revenue needs to be recognized, or you need to wait until you receive cash for you to recognize that revenue in your financial statements. That is just one scenario. Let's look at another scenario. Let's say I have been in my shirt business. Yes, I rented out a room where I put up my, the 10 shirts, and I have been selling these shirts. It is now time to prepare the financial statements, okay? So it's time for me to prepare the financial statements, but I have been occupying this room or the shop where I rented for the entire time, and the bill has just not yet come. Okay, yes, we are supposed to pay rent, but we've not been invoiced, or we've not yet gotten the bill for us to be able to pay the rent. So now at the point of preparing those financial statements, do I recognize that expense? Yes, I have incurred the expense, but I have just not yet paid the expense. And I have just not yet paid it because the bill has not yet come. Or it is possible that I have not yet paid the rent because I do not have the money. Maybe I intend on paying the rent the following year. The rent for this year, I intend to pay it the following year. So now the question is, do I recognize that expense in the financial statements? Yes, it is rent. I have incurred the rent, but I have not yet paid it, either because I've just not yet received the bill or because I do not have the money. I intend to pay this rent at a future date. So what do I do? Do I recognize the expense, or do I wait until I pay, then I recognize the expense in my financial statements? It could be rent, it could be water bill, it could be electricity bill, in other words, there are expenses that you incur. But at the time of preparing financial statements, no cash has exchanged hands yet. So what do you do? Now, this is the issue that is addressed by the accrual basis. According to the conceptual framework, it says that the accrual basis requires that all revenues and all expenses are supposed to be recognized when they are incurred, whether cash has exchanged hands or not. So in the illustrations that I have just given, if I sold off my shirts and these shirts, I've just not yet received the money, the fact that I sold them is enough to show that I earned the revenue. Because the shirts are no longer in my stores. I gave them out and I'm expecting money. So that is revenue earned, but it has just not yet been received. So it means that in my financial statements, I'm going to go ahead and recognize the revenue. So it's the same thing with expenses. You have been operating and you have incurred rent, you have incurred electricity bills, you have incurred water bills, you have incurred salaries. In other words, any kind of expense that you incur, you have to recognize it when it is incurred, regardless of whether you have actually paid cash or not. So that's the accrual basis of accounting. And we are going to see it in practice in our later sessions, where under a topic we call end of year adjustments. And in end of year adjustments, we basically adjust the financial statements to make them coincide with this very concept, the accrual basis, to make them coincide with the accrual basis of accounting. Here we recognize revenue that was earned, though cash has not come through yet, and we also recognize expenses that were incurred, though money has not yet been paid. So in a nutshell, those are the two fundamental concepts when we are preparing financial statements. The first one, that the entity we are preparing financial statements for is a going concern. And the second is that these financial statements are prepared on an accrual basis. Of course, there is such a thing called cash basis accounting. It is the reverse of accrual basis, but that will be a concept that we shall discuss another day. My name is Arnold Rangakuramya Kisembo, and this is Kisembo Academy.